What a time for a first appearance by my next guest, Mizuho Chief Economist Steve Richhiuto. Steve, a wild day. I'll summarize. You know, we have 3-month to 10-year at minus 25 basis points after a 25 basis point cut by the Fed. We have very little curve influences today regarding 10s to 2s. 2 years are down 11, 10s are down 10. Steve, what do you see out there, and underscore that with all the trade issues that seem not to be able to be resolved anytime soon?
Well, I think the clear message that we're getting is we're going to go back and retest the 150 level on the 10-year note. We've repeatedly tried to break through that in the post-crisis environment, and I think we're going to go back to test that level. I think we're probably going to fail at that level unless things get enormously worse from where we are right now, and I don't envision that happening. I don't believe what's happening in terms of the trade situation is going to be enough to bring the U.S. economy into a slower growth trajectory. I think we've stabilized around the 2.25% level, and I think what's really happening now, it's more a negative net global story, and I think the overseas interest rates will continue to be the place where most of the negative developments will start to continue to happen.
You know, Steve, what I find fascinating is I believe that the underlying economy in the U.S. is still pretty good. And let's be honest here, Sarah talks about how we can get all these negative feedback loops regarding how this encroachment, this issue with China may give us a negative appeal throughout the globe. But we're a consumption economy. If there's one economy that could take these trade issues, it's us. Your thought?
Well, you're 100% correct. This is the reason why we haven't had the net negative that people thought we would have coming through from the tariffs. Every economist has blown the whole discussion on the tariffs. First, they thought it was going to be inflationary domestically. That didn't happen. Then they look at the argument that, okay, if it's globally negative, that global negativity has to relate its way back into the U.S. The reality is the U.S. economy is fairly immunized from what's going on for exactly the reasons you talked about, which is why when you look at our inflation numbers, yes, the tradable goods portions of the inflation numbers are moving lower, but with a very, very tight labor market, the service costs are offsetting that, and we continue to run very, very close to the Fed's target of about 2% on inflation.
You know, Steve, here's the thing that's most dire to me, actually, is that we get caught in this Venturi cluster of lower sovereign rates. Very difficult to extricate ourselves from that. And it seems as though through models and much historical data significance tied into those models, the central bank seems to be getting caught up in the same downward pressure. On the short end, we're getting globally on the long end. Steve, this is such a unique situation with regard to no comps in the past. Are central banks relying too heavily on models that most likely have failed inputs and failed designs, considering the landscape of 2019?
Well, you're 100% correct again. When you look at it, we've moved from a world of excess demand to a world of excess supply, and the Fed has completely lost sight of that. During the crisis, the Fed used Operation Twist in order to flatten the yield curve and bring down long-term interest rates. What the Fed should have done in terms of their July meeting is they should have done more quantitative easing, and they should have done it in an environment where they rotated the curve back up by buying more at the front end and selling some of the ownership that they have at the long end of the curve and putting supply back in to feed the demand. The Fed has the tools to do this. They're just not doing it appropriately, and this is what happened to BOJ and largely to the ECB. They fell short on coming to grips with the realities before they wound up in the environment they're dealing with, which is zero short-term interest rates and a curve that's in the negative territory.
You know, Steve, for a second, forget all the moving pieces that we're discussing right now. If Christine Lagarde, when she takes over at the ECB, if she brings rates, let's say, down to minus 75, minus 80, or we see bond yields at minus 100, is there really any way you see our 10-year of being immune to having a significant percentage of that move priced into our yields?
Again, the Federal Reserve could use its balance sheet in order to do that. And we're given the fundamental economic realities in which we're dealing with in this country, the Fed should be using its balance sheet to offset what's happening in the marketplace. That's why we have the large balance sheet. That's why they should never have executed quantitative tightening.
Excellent. Steve, it's just an absolute pleasure to discuss this topic with you, and I would like to You know what, Steve? Steve, we have a little bit more time. So let's go in another direction here, another direction. When I see 7-1 breach with regard to the Chinese currency, and I see even small discussions that we should maybe try to devalue or move into the FX intervention game, that seems like a huge mistake to me. Your thought?
Well, again, currency intervention never has worked for us. The reality of the situation is we are the reserve currency, and we have to treat our currency with benign neglect in order to function as the reserve currency properly. And this is something we really have to take seriously in this particular environment. Trump could say whatever he wants politically, Mnuchin could say whatever he wants politically, but getting into intervention has always been a failed tool. It's never worked. And the concept that the Federal Reserve would cause it not to work by sterilizing is probably incorrect. It's just not going to work in and of itself because nobody is big enough in that market to really drive the size of that market enough to have a noticeable impact.